All right. Okay, everybody, welcome to tonight's webinar, Tax Savings for the Year End and the upcoming new year. So Chris Brown and Gene Bott from TaxHive are with us. We're super excited about this topic. So as you know, taxes are one of our favorite topics of all time because that's where the rubber hits the road. A lot of you guys are entrepreneurs, investors, real estate investors, and are very good at this, but there's some cool strategies. I know having Gene and Chris on with us from TaxHive makes a difference because they see a lot of different things. I was mentioning previously, we have a lot of people who have their home accountant. They may be great. They're probably great, but sometimes if you don't have someone like from TaxHive who sees a lot of different things, that knows a lot of different strategies, it's kind of fun to see because they've seen a lot of different ways of reducing taxes. It's all in the tax code. If you don't like what you're seeing, just flip a few pages and it's there somewhere. And that is truly the case. So great topic. Just so everybody knows, we have these, the webinar topics we do, usually once or twice a month. We try to do a webinar. Probably once this month just because of the holidays, but we have a lot of great topics and a lot of great individuals on there. And we really do love covering taxes the most, as you can see here, but a lot of different legal structures, investment strategies, and other topics we try to do. Stay tuned for that. If you want to see the recordings, we do put them on our channel for a period of time. YouTube, it's Protect Wealth Academy on youtube.com. So sign up there, you can subscribe. And we always mention our 3-day asset protection summit. This is our premier event where we have some of the experts here. We've had Chris on there. We've even had Kevin O'Leary, thanks to TaxHive. Fantastic, kind of amazing. Chris, you'll be joining us there. But this is really what we love to do, bring in the experts. You'll see, Dr. Danko, the Millionaire Next Door co-author, one of my favorite books of all time. Clint Coons, asset protection attorney. Former IRS senior trial attorney, Scott Estel, Don Pendleton, a lot of you know, and some other advisors we love to bring on. So that's coming up here February 6th through 8th, and then March 13th through 15th. These are on live stream via Zoom. And I tell you what, we miss being live and in person, but the cool thing is we have a lot of advisors and attorneys on in the background that can answer questions. And it's just very, very efficient for asking and answering questions. So if you have them, bring those. And same tonight, we'll have some, time to do some Q&A. But register online at protectwealth.com. It's our premier event, and we highly, highly recommend you spend time learning how to protect your assets and reduce taxes and set up your estate. And that's what the goal of the event is: a lifetime to accumulate and 3 days to protect it. So love to have you. We always do a disclaimer before we start any of our webinars. Of course, we're not trying to give legal or tax advice for you specifically. If you need specific advice, seek out a pro like someone at TaxHive. That's what they're there for. And Gene and Chris Brown. So Gene Bott and Chris Brown. Chris is the CEO of TaxHive, and Chris is one of the senior CPA advisors at TaxHive. So we are so thankful for you guys today. Great topic, and this is really, again, strategies how to reduce your taxes. And there's a lot of strategies you can do year-end and some planning for the new year. So the timing is impeccable, everyone. Thank you so much for being on. Gene and Chris, I'm going to turn the time over to you guys. Feel free to take the screen if you want, if you have some things you want to share. But thank you so much for being on.
Well, we appreciate it. We're excited to be here. And I promise we're going to give some tremendous kind of meat, practical advice and direction here today. So let me, maybe if it's okay with everybody, just tee up the idea of what we decided would be best for all of you as we approach the end of the year here. I want to spend just a couple minutes and kind of create the framework for why this matters as much as it does, and make sure that we understand what's going on. And then so grateful to have Gene carve time out of his busy schedule. He's a senior tax planner here, a partner at TaxHive. And I've asked him to kind of give a 30,000-foot view over just some of his favorite strategies that he helps clients implement every single day here inside of our company, and really give you an aerial view. I'm sure that not all of these things are going to apply to all of you, but I'm convinced that there will be some of these strategies that apply to all of you. And you're going to be able to pick out a handful of them. And the great thing about tax planning is if we implement a handful of strategies, it can equate to a lot of money being saved. Also, we're so appreciative of our relationship with Protect Wealth that we've also put together kind of a special bonus that I'll share with you here at the end. Just kind of a freebie for everybody here as a thank you to you for taking time, and a thank you to Protect Wealth for our relationship. And then as well, Gene's promised to stick on, and we'll take some Q&A. So I'll start, turn it over to Gene, then I'll jump back on for some of the Q&A if that's okay with everybody.
Yeah. And just so you know, I'll go in the background here, but the Q&A is what we use. So we don't actually use the chat screen. We do use Q&A.
Perfect.
So just keep that in mind.
Perfect.
All right, everybody, thank you so much.
Well, thanks, Kendall. Great to be with you.
Thank you.
Well, as we jump into things here, and again, I'm going to be pretty quick with my comments because I want to get to the heart of this, which is what Gene's going to cover. I want to just tee this up, though, with making sure that we all understand that we have control over where we're at and over the taxes that we pay. So much of this, however, is done through what we would call forward tax planning. We got to have a shift in our thinking. We don't want to look out the rear view mirror. What's happened behind us, we don't have control over. It's what's in front of us that allows us to impact the destination that we're heading and where we go and how effectively we get there. So we need to shift taxes a little bit and not make this once a year at tax time kind of thing. We need to make this something that we look at moving forward. To kind of illustrate the point here, I want to make sure that we understand the way that the tax code's written and why it's important to look forward. So this isn't a partisan issue. I don't care if you're Republican, Democrat, doesn't matter. The government understands the power that we as investors, that we as entrepreneurs have. So the tax code's been written to incentivize investing, to drive us and to fuel us and to push us to put money back into the economy. Here's the real numbers, again, that those that control and write the tax code understand. 2/3 of all jobs in the United States are created by small businesses, by investors like you and I. And 40% of the economic activity is attributed to the same group. So the reason that matters so much is the government understands that what you and I do with our dollars contributes to the overall health and success of our local economy and in turn our national economy. So the tax code's written to say, hey, if you're willing to take your dollars and you're willing to bet on yourself and build and grow and invest, we're going to give you incentives to keep more dollars in your pocket, in turn keep more dollars working for you, in turn fuel the economy. Now, what's the IRS's job in all of this, though? The IRS is a debt collection agency. They're the biggest, most powerful one in the world, and their job is to collect money. They're not going to, like we kind of mentioned earlier, come to us and say, hey, we think there's this remarkable strategy that if you implemented, you could pay us less. That's not what they do. In fact, as many of you know, they just hired or are in the process of hiring over 80,000 additional agents specifically to help collect more dollars. And when we talk about that, like Gene had mentioned earlier, they're not going to try to take more than what's rightfully theirs, but they're going to try to take every penny that is owed them. So our job is to understand the rule book, to understand the playbook, and play the game in a way where we mitigate and reduce our taxes. And I want to share one quick story before I turn it over to Gene. I grew up in the 90s, a big basketball fan. I watched the Bulls beat the Jazz multiple times, and it broke my heart. And I remember as a kid thinking that team is so talented that anybody who coached that team could win a championship, and I gave Phil Jackson no credit. Well, there's this amazing a documentary that came out recently. It's called The Last Dance, and it chronicled their final championship. It chronicled their last season. And it was really interesting to watch the brilliance of Phil Jackson that I had completely and utterly underestimated. You watched Phil. Phil was the one behind the scenes that watched the game video, that understood the other team's weaknesses and strengths, that understood his team's weaknesses and strengths, and built the game plan to position his team to be in the best spot to win. Phil was the one that called the timeouts during the game and made in-game adjustments to make sure that he put his team in the right spot to win. Phil was the one who called the play at the end of the game to put the ball in the right place, which was usually Michael Jordan, but not always. There's one spot in the documentary that I found really interesting. Many of you will remember Dennis Rodman. He's a character full of life and could be divisive in a locker room. And Phil, nearing the playoffs, decided that Dennis needed some time away from the team. So he let Dennis take a trip to Vegas. And as you can imagine, the rest of the team was upset. They were running into the playoffs. They were coming up on a playoff run, and they needed to be at 100%. And Phil sends Dennis Rodman away. And Dennis, true to form, I think he was dating Carmen Electra at the time, went to Vegas and disappeared. And they actually had to go get Dennis and bring him back. And it was interesting, as much frustration as that caused for some people, they asked Phil about it. And Phil understood his team so well that he knew that he needed to let Dennis go blow off some steam before they went into the playoffs so that he could have the very best player in Dennis Rodman. And of course, they went on to win their 6th championship. And as I watched this, I realized that, much like basketball, what you and I do in our investments and in our businesses have a lot of parallels. Number one is once the game's over, once the bell rings, once the buzzer sounds, there's not a whole lot we can do. It's inside of the game that we have to make the decisions. It's inside of the game that we have to execute. And so often people get to the end of the year, the buzzer sounds, and then they try to save money in the rearview mirror, and it just doesn't work. We have to look forward and make changes and adjustments in game in order to facilitate and execute on saving the most amount of money in taxes as possible. The second thing is as great as we are as entrepreneurs, most entrepreneurs don't understand the hundreds or even thousands of potential tax strategies that are out there. We need a Phil Jackson in our corner. We need someone like Phil that's going to help position us in a way to be able to win. Now, there's no doubt as entrepreneurs, as investors, we take the shots. At the end of the day, we're the ones taking the shots. We've got to implement the strategies in our business. But having somebody like Gene in our corner who helps us put together a vision and a plan of what we need to do to execute is what puts us on the right track to win. So here at Tax Hive, we're all about putting a Phil Jackson in your corner and helping you put together a plan that you can execute on in a real way to keep real dollars in your pocket. So what I've done here today is I've asked what I believe is one of our Phil Jacksons to come in and share some of his expertise. He does this all day, every day, helps clients save money. And I want to give you kind of a peek behind the curtain of some of the things. The opportunity is too much for us to cover it all. It's an impossibility. But I want Gene to kind of give you a peek behind the curtain and talk through many of the strategies that he sees as he meets with individuals one-on-one, day in and day out, and get your thoughts going about what are the things that you need to be doing in your game that are different than you currently are to, at the end of the day, help you keep more money in your pocket. So again, I'm grateful to have Gene spend some time with us. We'll have him hit kind of this view and this idea and show you some of the game planning type of stuff. We would love the chance to earn your business, but candidly, we want you to succeed as investors and entrepreneurs, whether you work with us or not. So hopefully we're able to earn some of your business. But even if not, I hope that you take things away from the day that are actionable to allow you to go do things to better your situation and improve your situation. And then certainly, again, I've got kind of a special bonus that I'm going to give to everybody here. And Gene will stick around for Q&A. So with that said, the man, the myth, the legend from our standpoint, Gene Bott. I know I've just set a high bar, Gene, but I have no doubt you'll clear it. Let's turn it over to you and let you jump in.
Yeah, thank you. So just so you know, I put a whole lot of content in here, and I tend to, when I put a whole lot of content, start running really fast. So Chris is going to help slow me down when I start speeding up too much. So if you hear an interruption, that's what's happening. So our agenda here, we've got basically 9 different areas we want to go over. This is just highlighting what those areas are. So if you wouldn't mind clicking to the next slide. Here's the first one. Your entity optimization is a big deal. We want to make sure you're in the right entity, and the vast majority of the time, that's going to probably be an S corporation, unless you're dealing with some real estate, which comes with some special rules. But we do want to double check that, because there are some points where that doesn't make sense, where roughly about 70% of taxpayers want to be in an S corporation. You don't want to be in the 30% that shouldn't be in an S corporation but made that election. So we want to run through that, make sure the numbers match. But just so you know, if you're out of time and you need to do it, you're probably better off being in that S corporation than not. But let us check that and make sure.
And Gene, I know I'm gonna pepper you with questions as we go through this. Explain for us real quick, if I'm generating income, why do I want to be in an S Corp? What is the benefit of being in the S Corp, and how does that help you save people money?
That's an excellent question. The great thing about the S corporation is it allows you to take some of your income and avoid what we really call payroll taxes on it. Another term for it is a self-employment tax. So the sole proprietorship and the partnership are going to pay 15.3% tax for the FICA wages on everything you earn. The S corporation allows you to take a large chunk of that, except for what we call a reasonable salary, and avoid those payroll taxes on it. The reasonable salary needs to be paid to you, and we'll still pay the equivalent of that through the payroll taxes, but the rest of it you can get out of there. Reasonable salary, there are two ways to calculate that. One, you want to, you can run with what's called the loose and dirty, where you just do 30% of your net income, and that's what you pay yourself in a reasonable salary. Some taxpayers will argue it's 50%. The truth of the matter is that's the quick and dirty way to calculate it, and chances are it's going to be fine if the IRS audits it, but it's not a guarantee. The better way, the much better way, is to actually figure out what it is you're doing for the company and pay yourself the reasonable rate for that, for you hiring for that. Do an allocation based off of buckets, though. It's much better to be bucketing out your hours than it is to just say, I'm a manager, and pay yourself that rate, because you're going to pay more.
And we want to pay ourselves as little as we can justify, right, Gene?
That is correct, yes. The less you can pay yourself, the more savings and taxes. But also just remember, the less you pay yourself, if you get below that reasonable rate, the more likely the IRS will say, nope, we're not going to allow that, and you're going to be in trouble. Okay, so deductions. This is a big one. A lot of people are very familiar with these first three. Some people aren't. We are relatively surprised at the number of times we see that people are not using these first three. The mileage deduction, you may not be using that, and legitimately not using that if you're using actual expenses on your vehicle. And just so you know, if you started on actual expenses, you're required to stick on actual expenses for that vehicle, and vice versa. If you do mileage, you're required to stick with that. So that might be why you're not doing the mileage. Home office, I've seen a lot of people that are not doing the home office simply because their tax preparer told them that the IRS is hunting that and is going to get you audited. The truth of the matter is, it's not. If you have an unreasonably large home office expense, that might get you audited. But if you are legitimately claiming that, that's nothing to be afraid of either. I've had several audits I've participated in over the years, and every single one of those to date has operated where I get a phone call saying, or it's actually usually a letter, unless you're dealing with states. States usually call you. But they either call or send me a letter saying, we're auditing this and we want to know more details. Please send us the backup documentation. We send that documentation, and that's the last I hear from them. And so that's the most common form of audit. Is it turns out to be just fine, just so long as you're obeying the rules. We want you to succeed in an audit. So when we work with you, we are telling you how to do these strategies right so that you have that 10-minute audit. And so that's our goal. Meals and travel, there's actually a really exceptional rule this year where you can actually deduct 100% of your business meals that you have in a restaurant. So that's pretty awesome. It was last year and this year, but next year it goes away. But there's still some pretty awesome stuff with meals and travel. Now, the accountable plan is one. If you do the S corporation, you might be required to get an accountable plan in order to claim these first three. If you're paying out of a business credit card, you're fine. But if you're not, you actually need an accountable plan in place, or you cannot actually claim the home office. You cannot claim your meals that are paid out of your personal credit card. You can't claim the mileage on your vehicle that's your personal vehicle being driven for the business. And you also can't claim any other deductions that you paid for out of your personal pocket. So just make sure if you're an S corporation, get an accountable plan in place. It can be as simple as Googling a one-page document and putting it there. Now, the captive insurance is the best of the deductions in here, but it's also the one that you actually have a bar you need to hit before you want to get into it. Captive insurance is where you come in and you set up a C corporation, and you have that C corporation actually provide some insurance to your company, and then you pay large insurance fees to that captive insurance. That allows you to shift the income away from your ordinary income, possibly to capital gains rates, or possibly never even tax at all. The caveat there is we are not comfortable recommending it to you until we feel comfortable you can put $75,000 plus per year into it. And that's our general rule of thumb. So we'll look at that. We'll evaluate your situation, let you know if it's right for you. But just know that's what we're talking about with captive insurance. And when you are working with that, you want to work with a captive insurance intermediary, and you want to be very selective on the one that you're using. You want to make sure they're doing it right. And the reason you want an intermediary is because if you're not doing it right, this is one that you can break the rules on and lose the game pretty easily. So that's why you want an intermediary. Okay, any questions on the, well, there we go. Loopholes and credits.
We've got some questions coming in, Gene. I'm answering some of them offline, but I'm going to store some of these up, and at the end, we'll certainly tackle some of these questions. There's some great questions coming in.
Okay, perfect. So the loopholes and the credits, the favorite one here is the Augusta strategy. This one, as long as you are making a profit, it can apply to you. If you're not making a profit, it doesn't apply. But if you are making a profit, you can actually rent your home to your business, which is going to allow you to actually take a deduction on the business. And as long as you're under 14 days per year, you don't have to report the income. You can pull a lot of money out without ever paying tax on it. So there's a website we like to use to help you get the rate. It's called peerspace.com, spelled PEERSPACE.com. And if you're using this website, you'll be able to find some support for $200 per hour, which is what we recommend for usually an 8-hour day. So you can pull roughly $19,200 out of your business. I say roughly when I give you an exact number. That's how accountants work. You can pull that much money out of your business without paying a dime of taxes on it. But if you go over that 14 days, you've broken the rules and you're now going to pay tax on every single penny of it. The other thing you want to make sure you're doing is actually hold a legitimate meeting and make sure you have some sort of record for it. Now, if you're doing an S corporation, the fantastic thing is you're required to hold board meetings, and those board meetings can be done once per month, and you just do the board meeting minutes and you've got your support. The one thing we caution you, don't put in how long you held the meeting, especially if you're not going for the full 8 hours. If you don't, the IRS will assume you're doing the 8 hours, but if you put in that you've done 2 hours, they're then going to take an issue with that because you're basically told them they have to take an issue with that. The other ones on here, solar credits and vehicle plugins. The government, of course, is working really heavily to help us all be encouraged to get off of fossil fuels and get into renewable energy. So they've provided some tax incentives in solar and vehicle plug-in. The solar credits were set to expire this year, but they have actually been renewed. And so they're carrying on, and it's pretty awesome. The vehicle plug-in credit is also pretty awesome. If you are wanting to get an electric vehicle, you can definitely get a tax credit, dollar for dollar tax credit for that. There is a different tax credit for every type of electric vehicle out there. So you just want to check with the IRS to see what the tax credit is before you buy. The biggest one to know about, Tesla. That's probably the most commonly known electric car out there. It also does not qualify for a vehicle plug-in tax credit right now. It expired last year and it has not been renewed. So, all right, retirement strategies.
One thing actually, before you go on to that, I got a bunch of questions on this, so I'll just reiterate it right now. The website Gene gave you was PEERSPACE, PEERSPACE.com. And this is something that we see, A, most people aren't using, but B, even the ones that are using it are often vastly undervaluing the cost of a boardroom. Gene typically recommends, as he pointed out there, about $1,600 a day, which that adds up to a huge deduction for the year. Again, close to $20,000 if you max it out using that one strategy. But the website there is peerspace.com.
A couple quick things to note on that website. Search for a boardroom and then search for your state, not your city. And then the other thing to note is you're going to find pricing in there as low as $18 per hour and as high as $700, $800, $900 per hour. That's why we recommend the $200 range. It's really right in the middle there. If we found it's really safe with the IRS, we have not seen them push back on that to date. That's not to say they won't, but we haven't seen it. And it's been used by a lot of taxpayers. But just know the more aggressive you get with your rate, if you go in there and charge the $700, you'll probably get some pushback. So just don't be too aggressive. Be able to justify what you do. All right, so retirement strategies here are a big one. There are some really fast ways to make some tax savings with retirement strategies. And the really awesome thing is most of these, you don't even have to fund them by the end of the year. You just have to have the account set up by the end of the year. And that gives you some leeway on when to make the contribution. Now, I do want you talking with your financial planner about that to make sure that you're not missing the boat for a couple of reasons. First, you don't want to be the person that does not have an account set up but thinks they do. I've seen that happen, and it really hurts. Second, you don't want to be in a plan that does need that contribution by the end of the year and end up not making it. So just make sure that you're talking with them and you get this done when it's right for you and for the plan that you have. There are defined benefit plans and there are defined contribution plans. The defined benefit plan is basically the equivalent of a pension plan, and that's how they work, where you're basically defining what you're going to be getting back out of that. And then there are defined contribution plans where you define what is going into it. And they have different limits. You tend to be able to put a whole lot more into a defined benefit plan than you can a defined contribution plan. But there are some downsides to that as well. So make sure that, again, you're talking with your financial planner. You're making sure that what you're using fits you. And we most often, when we look through this, we'll let you know which strategies are going to save you the most in taxes. But this is where you want to work with a good financial planner and a good tax planner, because you want to know what's going to save you the most in taxes, but that's not always the best strategy for your financial future. Chris, you have some questions, but you're on mute.
One thing I would just point out there, and I just want to reiterate, Gene already said it, but I think it's important to recognize, but these contribution plans are one of the few areas that you don't have to contribute this year to get the tax deduction. So just to make sure you caught what Gene said, you've got to have the plan established this tax year, but you just have to fund it before you actually file your tax return. So this is one of those things that if you don't have the money today to put in, you can put that money in February or March and actually get the tax deduction this year. It's one of those great tools when you talk about year-end planning. A little bit of foresight, getting the plan set up, even if you make the contribution next year, is going to save you some money.
Yeah, excellent. All right, charitable contributions are one of my favorite just because I really like giving and I think it's awesome to use it. But there are also when you do giving the right way, you can recognize some huge tax benefits for it. And there are several right ways to do it. We've got 5 general categories listed out here, but just so you know, like the donor advised funds there is a generic category. There are actually the donor advised fund trusts. So there is one that actually carries that name, but there are 6 other categories that we tuck into here with the donor advised funds when we talk tax planning with you. And all of them are a form of you're giving to a charity, but in a way that is helping you grow your wealth while also save on taxes. Just know that the vast majority of these are using a trust strategy in the donor advised funds. When we talk about the cost versus retail strategies, this is where you're going out and you're buying some sort of asset and donating it to a charity. And that allows you to actually buy it at a cost typically and donate it at retail prices. The one here on the bottom, conservation easements, is typically dealing with land. I do want to give you a caution out the gate. That is a heavily hunted tax strategy by the IRS. If you're doing it the right way, there is no problem with that. They're going to come in and it's going to be another one of those very quick and dirty audits where they go away because you've got all the nice paperwork to support it. But it is heavily hunted. You want to make sure you're working with somebody that really knows what they're doing with those. The mineral deposits and the arts grants, those are not hunted by the IRS. It's because they have not been abused like the land grants have been. And they're fantastic strategies. The really cool thing about this one is we have seen that the average tends to be somewhere between 3 to 4 times the tax savings per dollar you put in. So if you go in and you buy $50,000 worth of mineral deposits, for example, you can get a $200,000 write-off quite commonly, which works really well for you as long as you're in certain tax brackets, which is often why the $50,000 comes into play as well. That's when we know you're in the right kind of tax bracket. If you're paying 10%, this isn't in taxes, this probably isn't the right strategy for you. But if you're in 25% better, this is good for you. Charitable gifts is just doing regular gifts through your itemized deductions. We've got qualified charitable distributions where you can take some of your retirement savings and tuck them away into a charity and recognize some tax savings and avoid the penalties that come with an early distribution on that. And then we've got private foundations, and that is basically where you're giving to a non-qualified charitable organization rather than a qualified charitable organization. And this one is pretty popular if you want more control over what your charity is. It's usually you're actually building the charity. So that's kind of what a private foundation is. All right, so health strategies. This is a big one right off the top there with the self-employed health insurance deduction. I'm surprised at the number of times I see people claiming health insurance deductions on their itemized deductions when they're running a business. If you're doing that, you're missing something, because there's a way to run it right through your business and get a dollar for dollar exchange rather than missing out on that first 7.5% of your 7.5% of your medical expenses. The HRA and the HSA are also fantastic strategies. The HRA is more for your employees than it is for you, especially if you have an S corporation. But the HSA is pretty fantastic in that it allows you to put some money away if you're on a high deductible health plan. So just so you know, there are some PPO plans out there that are not, but there are also some PPO plans out there that are. And so just know if you're on a PPO plan, we need to look a little closer to see if it really qualifies for you. Yeah, there are the health strategies. Deductible loss strategies, these are really fun. This is where you get to take something that you've lost money on and deduct it. Now, the truth is you don't necessarily have to actually lose money. So the tax loss harvesting is a situation where you have some losses related to some investments you have. You sell those to capitalize on those losses. I don't typically recommend doing that unless you're working with your financial planner and they've looked at it and said that, yeah, this makes sense for you because we could sell these losses and recognize these gains, or really you just need to get these losses out. So talk with your financial planner when you're talking about this first one, especially. The oil and gas investments and the SOP are actually a little bit different in that you don't actually have to be losing money in order to recognize some savings there. The oil and gas is where you go and buy into a partnership that is building some oil and gas rigs. And you actually get to take some, when you do that and you do it the right way, you get to take some deductions related to that depreciation and you can use it to offset your ordinary income. It has to be done the right way though. So make sure you're working with the right people that know how to do this correctly. Because you're getting that depreciation, you can often have some income coming in from that investment and still be reporting losses on your tax return, which is pretty cool. The same is true of the SOP. This is a strategy where you're actually buying into a company that has massive amounts of losses in the past, and they're willing to let you have those losses so that they can have some ability to use your funds to help grow the business. So you can be bringing in some money, getting paychecks from them every year, but in a partnership return, you actually have the ability to have the losses allocated directly to you, even though you're getting some money. And that's this whole idea. It's a tax loophole that allows for that. All right, so deferral strategies. These are strategies where you're not actually avoiding paying the tax. You're just pushing the tax into a different period that makes sense for you. Qualified opportunity zones are one of these strategies. Now, they're not entirely, that you can actually recognize some tax savings with this as well. The qualified opportunity zones, if you have something where you've recognized some capital gains this year, you can actually push those into 2026 by getting into a qualified opportunity zone. Or the really big benefit is if you buy or invest in a qualified opportunity zone or create one, opportunity zone fund, excuse me, and you hold that for 10 years, at the time you sell that asset, it gets a step up in basis to its fair market value at that time. So you can actually completely eliminate some capital gains using this strategy, just not your current capital gains. That's the one that you're pushing into the future. The 1031 exchange also allows you to defer capital gains on an asset, but this one is you defer it until the point in time where you actually recognize it. The difference is on the 1031 exchange, you have 45 days to identify the replacement property. The Qualified Opportunity Zone Fund, you have 180 days from the date of the recognition of the taxable gain, which is the end of the tax year of the reporting entity. So that was a whole lot. Ask us questions later about it. You're going to love it. It gets complex. Bonus depreciation and Section 179 deduction and cost segregation. All three of these are strategies where you're taking depreciation from the future and moving it to today with the belief that the deduction today allows you to keep some money that you can get growing better, so that's better for you in the long run. And we have seen that the vast majority of the time that holds true. But just know you're stealing from the future to do that, just usually with better results. Okay, employee strategies. These are ones where you're actually going to make an investment in your employees. And the whole idea here is not to get a dollar for dollar exchange. It's to be able to get more from your employees, and while you're at it, also get tax savings. So admittedly, these strategies will cost you more than you're gaining from a dollar for dollar standpoint. But it's the benefits of helping encourage employees to work with you longer, be with you more, and avoid that having to retrain employees and lose key employees that you're really looking for with these, coupled, of course, with the tax savings. Some of these are contributing to retirement accounts in their behalf, or even just setting up a 401k so that they have the option themselves. The health savings account we previously talked about. Fringe benefits such as life insurance policies, disability insurance, long-term care insurance, and stuff like that. These bottom two are pretty cool ones. Employee Achievement Awards, that's where you take bonuses and make them more of a tangible asset rather than a cash bonus. Up to a certain dollar value, you actually can avoid paying, or cash bonuses have to go on a W-2, and you and your employee have to pay FICA taxes on those if they're over technically $25 per year in total bonuses. But if you're doing this Employee Achievement Award, you can actually avoid up to $1,600 of that as long as you obey the other rules. Qualified Education Assistance is where you help them pay for their school, typically through tuition, but you actually do have an option as of a couple of years ago to help them pay for their student loans as well. So those are pretty cool. How are we doing on time? We're doing good. Okay.
We're doing okay.
Great, because we just hit the end there. So we're now ready for questions.
Yeah, so number one, Gene, fantastic job. And I know you blew through this. And our idea here is we get to spend time. There's hundreds of you on here. And I knew that because of that, there's this diverse group. So we asked Gene to go wide instead of deep. And so we highlighted a lot of different ideas and a lot of different things. And so we want to certainly spend some time that we have here going through question and answers. Before I do that, I want to share with you kind of the special freebie that we're throwing in for being here tonight because of our relationship with Protect Wealth. And I want to give you just a little bit of behind the scenes what Gene does. So Gene has these conversations with our clients, and then what he does is he builds a specific tax plan out. So here's an actual client's tax plan. These are usually, what would you call them, Gene? 40 to 80 pages, depending on the size of the business.
Oh, I've seen them from 40 all the way up to 160.
So there you have it, with the projected tax savings. But here's the key thing is as Gene builds these out, he breaks down each strategy and gives a description and step-by-step implementation on every single strategy. So when we talk about a game plan, this is what Gene does for our clients, is builds this game plan with the step-by-step directions on how to implement each and every strategy. Again, we would love the opportunity to earn your business, but even if not, I want you to see what good tax planners are doing to help people like you keep dollars in their pocket. This isn't just a conversation and good luck, but Gene will actually look at a tax return, do a questionnaire with each client, and really dig deep to find where the areas are. And so because everybody on here is part of the Protect Wealth family, what we've agreed to do, and not just agree, but what we're happy to do is to offer a free session to talk to one of our team members about where you're at and see if our services are or aren't right for you. and no obligation. It's just something that we want to do for all Protect Wealth clients. With us coming on the end of the year, I've asked our team to open up spots. So I know we're all busy. So what I would invite everybody to do real quick is just to pull out your phone and just scan this QR code. And this will take you right to a site where you can schedule a time to have a conversation with one of our team members to discuss a little bit more about your specific situation, a little bit more specifically about how we would help, about some of the guarantees and the warranties that we have behind our work, to see if this is a good fit for you. I would point out, Gene, I don't know if you just saw these updated numbers, but we just ran some numbers on our clients' tax plans. This is taking small startup businesses to established businesses. And as we average them all out, on average, we're finding over $20,000 in tax savings, not deductions, actual real tax savings with the work that Gene and his team do. And we're confident and believe that we can help do the same thing for you. So I would just invite each of you, pull out your phone, scan the QR code, schedule a free time to meet with our team to see what we can do to help you keep more dollars, real dollars in your pocket, and not pay a penny more than the tax code requires you to pay. It's a special thank you for, number one, being with us here tonight, but also because of our relationship with Protect Wealth, we want to do all we can to hopefully provide some real quality and some real value to each and every one of you. So please, if you would, go schedule that. If you don't have a phone to take a picture, you can go to protectwealth.com. We missed the .com in there, it looks like, Gene. That might be my bad. protectwealth.com/tax hive and schedule that free appointment there. Kendall, you just got to correct us on that.
Yeah, no, you're good. In the chat screen, I did put the actual link, so that in the chat screen, you see that pop up, you can actually click on that as well, if that's easier for you. Either way.
Didn't we learn in 2008 we don't want .coms anyway? So
Yeah,
we're okay.
Yeah.
Just sorry, bad.
All
humor.
right, well, go schedule that free consultation. But Gene, let's jump in and let's answer as many of these questions as we can. Does that sound fair to you?
Yep, that sounds great.
So first question, and I'm going to ask these questions even if I'm afraid you're not going to love the answers. So we want to get you the information you need to make the right decisions. But Gene, talk us through short-term capital gains. Are there things that I can be doing to offset short-term capital gains that I garnered this year?
Yeah, so short-term capital gains, that oil and gas strategy will work offsetting short-term capital gains. You can also offset those with short-term losses and other capital or long-term capital losses. Just know that they will offset in their current bracket first before they go into the other ones. The real struggle you have when you're talking about capital gains is there is a limit on how much you can use it to offset ordinary income. You can't really use capital gains to offset your ordinary income above the $3,000 mark. Does that answer the question pretty well, or do you think I missed something?
No, that's perfect. I think that's great. And because we have so many questions, Gene, I may not provide much commentary. I may just blow through these to get as many of these answers as we can. Any suggestions for trading futures and day trading as far as entity setup, how I may or may not be able to take advantage of some tax rules if I'm a day trader and wanting to do futures?
Yeah, so day trading is a tricky beast. There are some really, really hefty tax rules around it. There's something called a mark-to-market election that you can make that can often help you avoid the wash-sell rules that make you not able to recognize some of the losses. So that might be something you want to consider. The thing with that mark-to-market election, though, it has to be made when you file the tax return for the prior year, which means when you file this April on your personal tax return, unless you're doing a business return, then you need to do it by the March deadline. When you file that, you have to make the election to do the mark-to-market election, if that's what you're wanting to do.
We have an C Corp, not an S Corp. We rent houses. Should we be in an S Corp? So let's kind of split this into two things. We have rental properties. Your answer is going to be most likely, I know we shouldn't be in an S Corp. What are your thoughts on a C Corp from a tax side for rental properties, Gene?
So real estate is another tricky beast sometimes. There are a couple different pieces that we have to consider. If you're holding investment properties, particularly fix and flips and stuff like that, you're often treated like ordinary income, and then the whole S corporate rules go out the window. But when we're talking about rental properties like what you're talking about, we typically recommend that you hold those in LLCs. Filing as either a sole proprietorship or as a partnership or sole proprietorship. And then you look at actually holding that within a trust rather than within a C corporation or an S corporation. And the reason there are actually some tax rules on the back end related to those that can be pretty hefty for your beneficiaries when the time comes that they inherit those assets. An S corporation, for example, gets a step up in basis, but the property it holds does not. And so then when it sells that property, you have a huge capital gains that your beneficiaries are now paying tax on that they wouldn't have had you just held that in an LLC within a trust.
Great. Coming to home office deduction, and this is one that we see all the time, Gene. People like to get creative here. So just walk us through this so we don't get in trouble. Instead of taking the home office deduction, can my business pay myself rent? I have a converted garage used exclusively for work. I have an entire basement set up just for my work. What are your thoughts on business paying myself rent versus taking the home office deduction?
That's an excellent strategy so long as you're totally fine with paying tax on that rent that you're paying yourself. But if you want to avoid the tax related to that, you definitely want to get it into the home office deduction. Just know that the way the code is written, anything that you rent out for more than 14 days is required to report the rental income and then pay tax on it. And so that's why it's not really it's not the best strategy from a tax standpoint for you to have that rental coming in. The other thing is if you are renting that garage space, or excuse me, that home office space, if it's in the garage, you're probably still fine. But if you're doing it actually in the house, you have some risks of not being able to use the Augusta strategy because all of a sudden you have more than 14 days that a portion of that house is actually legitimately rented. And so now you've got a problem maybe using that Augusta strategy. And when we're talking about $19,200 that you can possibly pull out of the business for the Augusta strategy, we're usually talking somewhere between $4,000 to $7,000 of tax savings on that strategy that you just handed away in order to save a little bit of difficulty by just doing a rental. I don't recommend it.
Just to make sure you caught what Gene said, if I'm renting it, if the business is paying rent, I'm getting the deduction on this side from the business, but then I'm also having to claim the income on the personal side. I can't have it both ways. Whereas with the home office deduction, you take the deduction and you're not claiming that income anywhere. And so that's a key to understand. Now, in relationship to the Augusta rule, Gene, there's some questions that came up. Do I have to be a C Corp or an S Corp? A single member LLC, where or how do the rules change depending on my entity structure with the Augusta rule?
That's an excellent question. There is no definition within the tax code as to what your entity structure must be. There are a whole lot of opinion pieces on the internet about how you cannot use this in a sole proprietorship, but we have never seen that within the tax code, and we have never seen that supported by a tax case. And so why it's being argued so heavily, we don't actually know. Somebody started that rumor and it's just carried on. And for that reason, there are a whole lot of sole proprietorships out there that are gun shy on using this strategy, but you can actually use it. The only thing you need to keep in mind is you have to use it for a legitimate business purpose. An S corporation and a C corporation have a really easy ability to claim that they're doing a board meeting because they're required by law to hold those. But a partnership and a sole proprietorship could also do a board meeting. You just need to make sure it's above board and that you're actually doing them.
So then we have a question here, one more kind of in relation to the Augusta rule. If I didn't use the Augusta rule in 21, so hypothetically, I had board meetings, but I didn't pay myself. Can I go back and amend to 21 and pay myself now if I didn't do that? What are your thoughts on going back and amending and changing for last year, Gene, if I didn't use the strategy correctly?
I'm totally fine with that being done. You can definitely do that. Just know that the IRS can technically reject that if they choose to. because they could easily make the argument, well, you must not have known about it, you must not have been doing it. But if you can document it, you can support it, everything along those lines, there's no reason to be gun shy about that and go back and claim it. I am far more willing to do that if you have another reason to amend the return than if it's just for that. But even with just for that, as long as you're okay with a potential fight with the IRS, don't hesitate, do it.
Great. I've heard you can do a 1031 exchange, even buying a new property that is less than the original property sell price. Can you do this? You know, there's this idea that I have to buy a like kind property. It's got to be more. The question is, can I buy a property that is less expensive than what I just sold?
Yes, you can. You can even, so there are a few different ways you could do this. You could buy a property that's less. You could buy multiple properties that are less. You can buy a few properties that are more. There are some restrictions on the more, and there are even some restrictions on the less. The big thing to know when you're going with a property that is less is just know that there is a proportionate breakout there on what is taxed. Meaning, if you say spend 50% of the income you get from the sale on a replacement property, you can only recognize 50% of the 1031 gains deferral. The other 50% is going to be taxed.
Great. We got lots of questions. We'll keep going, but if you haven't, I would just invite you again to scan that QR code, go to protectwealth.com/tax-hive. And for everybody here, we want to spend time with you, offer you a free consult with one of our executives here to spend some time and have an account executive talk to you about where you're at and how we might approach helping you and see if we can't help you save some money. My belief is we can help all of you, but we want to have that free consultation to talk through with you what we may or may not be able to do and what you might be able to do to keep more money in your pocket. So if you haven't yet, go to either scan the code or go to protectwealth.com/tax-hive. Gene, I'm being asked to have you define a little bit more about what a qualified opportunity zone is. So we hit that pretty quick. What is a qualified opportunity zone?
Yeah, so back in 2016, right around the time that the Tax Cuts and Jobs Act came out, there was another bill that was passed that didn't get a whole lot of notice because of the Tax Cuts and Jobs Act. But it was a bill that that told states that they had to set aside a certain portion of their land within the state and designated as an opportunity zone, defined as an area that was depreciated in value, and we wanted to help improve the value of that area. So the whole goal is to get investors to go in there, put some money into investing the businesses that are there or the properties that are there and stuff like that. And that's what the that's what the opportunity zones are. So a qualified opportunity zone fund is basically you have now set up a business there, and you've got a fund operating that allows you to transact the business related to whatever's happening.
So here's a great question, and I'm going to expand it just a little bit. The question is, if I have $20,000 in wages in my S Corp, which retirement plan will let me put the most in a retirement plan? And so they're kind of asking a specific question. If I'm pulling 20K out in wages, how do I figure out where to put the most amount of money? But let's talk through just a couple of the different retirement plans. And just briefly, Gene, I know you could probably give a discourse on every plan, but just briefly, what are the plans I should be aware of, and what rules apply to which one? What do I need to be aware of when choosing a retirement plan?
Yeah, so this is an area where I am very careful in that I don't really want to give you too much detail on these. I really want you working with your financial planner. They are the experts that will be able to balance what's happening in your account with your overall financial picture, coupled with working with us typically to make sure that you're capitalizing on the best tax strategies. When you're talking about $20,000 out of your business, though, $20,000 is a relatively low payroll, and most of these strategies are actually going to be able to be maximized using that. When we're talking about general limits, a lot of the strategies we're talking about, the simple, the SEP, stuff like that, there is a 25% of your earnings is what you're able to use in that. So with $20,000, a lot of them are going to be limited to about $5,000 in what you're able to put into it. And you can really do that in just about any one of those. The 401k profit sharing would be another fantastic one to use, where you don't actually have to necessarily have a profit in there to be able to do that. Then a defined contribution plan, a defined benefit plan may give you more flexibility on doing some more funds, even above that 25% limit. There are some upper end limits. Just be aware that things like the traditional IRA has one of the lowest upper limits, where you're capped at in the teens, whereas most of them are for business owners up in the $50,000 range. And then the defined contribution is significantly higher.
Great.
Defined benefit.
Here's a quick question. A lot of this individual say, I've heard CPAs say, just take the $1,500 simplified deduction for the home office. What's your opinion on taking the simplified deduction versus taking the actual when it relates to a home office? Gene, what's your experience been?
So the simplified deduction is $5 per square foot for the area in your home that is set aside for your home office. The average home office size is 150 square feet. When you're talking about a home that's in the 2,000 square foot or less range, when you get up in 3,000 square foot and higher, we're typically talking 200 square feet, and that's the average home office. That's more than the average. Most home offices are around that size, unless you're adding some garage space and stuff like that. So we're actually talking about a much lower simplified method deduction, and you are more often than not you're not going to get as big of a tax savings using the simplified method as you are the actual expenses. The caveat being the actual expenses take more work.
They do. Again, I'm going to keep plowing through these and try to get through as many as we can here. If we purchase a vehicle over 6,000 pounds in order to deduct the full price of the vehicle in that tax year, so there's the section 179 here, what we're talking about, accelerating the depreciation. Does the business need to be profitable, or can I take a loss on section 179?
So section 179 and bonus depreciation both will allow that. And you can actually take a loss on that, yes. Just know that there might be some additional limits related to luxury vehicles and stuff like that, where you might be limited to $25,000 rather than the full deduction.
And if you're limited, does that mean I lose it, or does that just mean I have to roll it over and take it over a number of years?
It just means you roll it over and take it over a number of years.
Great. Any specific strategies that you might recommend for someone running a home daycare business as an LLC out of their house?
That depends on your profit level. I would, generally speaking, recommend that for a daycare running out of your house, you do first and foremost look at the accountable plan. It's not, not the accountable plan, the Augusta Strategy, followed by the home office deduction, if you can set aside some space for a home office. And then you may want to avoid doing some rental of your space for that daycare as well. I'd imagine that you're probably not, but if you are thinking about it, don't do the Augusta Strategy instead. It's so much better. Once you're beyond those, you probably want to start looking at things like the S Corporation and stuff like that.
A couple people on here would just love your thoughts on the new 1099 rule with Venmo, PayPal, where they're going to start reporting over $600 transactions. What do we need to be aware of there?
First and foremost, that shouldn't have changed anything for you. If you're taking payments through Venmo or PayPal, you should have been reporting that income anyway. So this isn't really going to change anything for you if you've been doing it right. If you haven't been doing it right, then you are going to have a little bit of your world rocked, where you're going to have to start reporting some income that you have not been reporting otherwise. The only thing to keep in mind, though, is if you're an individual working really heavily through Venmo, this may cause you some reporting issues, where if you're just selling personal assets and stuff and you're getting paid for those, you're now going to get a 1099 and you need to justify that that's not business income. So just be aware of that need there. The other thing to keep in mind is there is now a Venmo business account That does cost a little bit of money, but if you're operating a business through Venmo, I highly encourage you to go that route, because the Venmo free account comes with some significant issues related to your liability with clients, because they do not protect data. That's a legal matter, though. Seek legal advice.
Yeah. Can depreciation be used to offset capital gains?
Depreciation. So yes and no. It depends on what type of entity we're talking about. So if you're talking about depreciation on your rental income, probably not. It's passive. It's not going to really be able to offset your capital gains. If you're talking about depreciation in your business, well, that's ordinary income that often is able to offset everything. So there's a good chance that that one's doing just fine. If you're talking about depreciation on an investment property, then I might wonder why you're taking depreciation on it to begin with. So we have to talk.
Absolutely. Well, everybody, I wish we could go on for hours and hours, but I know we can't. We'll have to come back. We would love to come back. I'm sure Kendall won't even have to twist our arm, but we would love to come back. But
do you mind
Kendall,
if I?
Oh, go ahead, Gene.
Do you mind if I interrupt and answer this first one that came in?
You bet.
Way
Go
earlier?
ahead, Gene.
There's this one about the annual gift exemption and whether or not there's some disadvantage to making more than that. The answer to that is yes, there is a gift tax on that. And you just need to be aware that if you're exceeding that annual gift exemption, you need to be filing a gift tax return, and you are going to pay some taxes on that.
Great. Well, Kendall, I'd love to just give 2 invitations if it's okay before I let you wrap it up.
Please.
You know, number one, hopefully, I hope that you've all gotten something out of our time with Gene. I'm super appreciative of him and his brilliance, and just the wealth of knowledge that he brings. And so, you know, this is representative of our team, and so grateful to have him. If you haven't scheduled that consult, please scan the QR code, go to protectwealth.com/tax-hive. But the other thing that I might ask, you know, we took time out of our schedule to be here. Gene worked hard to put this together. You know, we live in a world where online reviews matter. And unfortunately, your raving fans rarely go leave reviews, right? So we have to ask for them. And I would just be so appreciative. Our goal is to give you a 5-star experience. If it's been a 5-star experience, if you've appreciated and got something out of this, I would appreciate greatly you going to taxhivereviews.com and just leaving us a great review and mentioning something about the time that you had with Gene and I. You leave a review on Google or Trustpilot, or both would be appreciated. And if you would just take 2 minutes of your time to do that for Gene and I, we would greatly appreciate that. But Kendall, thanks so much for letting us come on. It is wonderful to be with you.
Thank you very much, guys. Gosh, if I just had 1/10 of the stuff you guys know on taxes, I'd be doing so much better. Unreal, guys. Thank you so much. I can tell you guys know your stuff. So it obviously shines through here. So thank you, Gene. Thank you, Chris. We really do appreciate your time tonight. And guys, I highly, highly recommend you sign up for the consultation. A lot of times you have your CPA or your accountant, your attorney doing taxes for you. We run into this all the time, and they find things here and there for you, but they're not at all finding things like what Gene just taught or Chris just taught. Unreal strategies. These guys can get you really to that next level. And it doesn't hurt to have that consultation. Highly, highly recommend it. We've had a lot of students go through this and find a ton of savings. So please take the time to do that. It's worth your time. And the thing is, it's not just 1 year. It's pretty much year over year over year, business and personal. So think about that money. I mean, it's a big deal. So guys, thank you so much for your time. Click the link, sign up. We'll send this out recording tomorrow, and please reach out if we can help you guys. Gene, Chris, again, thank you so much. Really drive safe tonight, guys. We appreciate it.
Thanks. Have a great evening. Thank you, everybody, for spending time with us. We know you're busy. It's great to be with you.
Good night, guys.